सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
2022 is coming to an end, and it's a great time for us to now look back over the year and see how the economy has performed and where we are now. In previous episodes of Macro Sutra, we've talked about GDP growth, and especially in the episode we did after the Q2 data came out, we looked at how various sectors were growing, which were doing better than others. But there are other aspects to the economy that need to be looked at, some of which have been hits and some of which have been misses. This is what we're going to be looking at in this episode of Macro Sutra, the last one of this year. What have been the hits and misses in the Indian economy as it's bounced back in 2022? I'm TCA Sharad Raghavan, economy editor at ThePrint, and we have with us Radhika Pandey, senior fellow at NIPFB. Thank you so much for joining us.
Thank you.
So now we start with one of the key sectors for the economy, which is the banking sector. The sector is important not just because it gives credit to companies to invest, but it also gives loans to you and me, when we're buying houses, cars, all kinds of our expenditures funded through credit from the banks. So the health of the banking sector then is crucial for the health of the economy. So how has the banking sector done this year, and how has credit delivery been?
Yes, so this year has been particularly very good for the banking sector. So banking sector, if you look at the various indicators to assess the health of banks, be it the capital position, be it the asset quality, which is assessed through non-performing assets, be it the credit growth, all have witnessed stellar performance in the year 2022. One of the reasons for that is that we had an asset quality review in 2015 where the bad assets were recognized, and after that we've had a stringent regulation on assessment of NPAs, and after that banks have become much more careful in advancing loans overall, and that is what is visible in the bank's profitability. We had some banks that were placed in the prompt corrective action framework, which is something a kind of enhanced supervision over those banks which are not performing well. But when they start performing well, they are removed, they are out of the ambit of PCA, the prompt corrective action framework. And now we know that we don't have any bank in that framework, which means that banks have improved. So that is one thing. And the other thing is that despite successive interest rate hikes, so we've seen RBI raising rates to tackle the high inflation. Despite that, we have seen that credit growth has been robust. It has been in double digits. And what is distinct from the previous year, 2021, has been that last year credit growth was driven by one or two sectors. Primarily, it was driven by personal loans and services. But this time around, if we see that even the industrial credit has picked up, which is a very good sign for the economy. Some part of it is working capital requirement, which is to address the rising input cost pressures. But it is also that industries' balance sheets are much better now, so they are able to demand credit. So credit has grown and it has become more broad-based. So that is one of the key points of the banking sector. The other important point is that even the public sector banks have done very well. So we had a discussion in one of the episodes of Macro Sutra where we've talked about public sector banks doing extremely well. Second quarter performance was almost double-digit growth. Their profitability was very high. So all these bode well for the health of the banking sector.
And the health of the banking sector, then it also means that if companies are taking more loans, then possibly in 2023 we can see more investments and maybe more job creation.
Yes. So on the domestic front, if we just look at domestic front, definitely that is the case. But investments also depend on what is the situation externally. Are there more global headwinds coming? Is there more uncertainty? What is the situation on inflation? Because one of the key criteria for sustained investment growth is low and stable inflation. We need to have a regime of low and stable inflation. Then we can see sustained investment revival. So investment depend on a number of factors, but standing as of now, we do see some signs of revival in private investment.
Right. And now coming to the global headwinds, that India has been one of the bright spots in their economy, and we've been a destination for global foreign investment. Has 2022 seen this kind of enthusiasm sustained? Because I know that in 2020, there was quite a lot of investment, record investments, in fact, FPI investments that came to India. Now in this year, have we seen that kind of taper off, or is the enthusiasm still there?
Yeah, so we saw a complete reversal of what happened in 2020 and 2021.
Okay.
So we should know that in 2020 was a period of COVID. It was a period of ultra loose monetary policy being pursued by advanced economies. So interest rates in advanced economies was low, and in India, comparatively, the rate of return or interest rates was high, which propelled inflows of foreign investments in India.
Right.
So in 2020, we saw, if we look at the data on foreign portfolio investment inflow, more than 1 trillion or more than 1 lakh crore of net investment flew into the economy in 2020. In 2021, also we saw investments flowing in the economy.
Right.
But in 2022, since we know that there was a reversal of the ultra-loose monetary policy because advanced central banks started raising interest rates, so foreign investors started flowing back to advanced economies.
Right.
Because the interest differential between Indian-denominated assets and dollar-denominated assets, that interest differential narrowed. So it led to a reversal of flows. But here also what is important is that the entire story of 2022 can be studied in two parts. The first half was a case of aggressive outflows because at that time was an immediate impact of the war. We saw inflation in the US touching almost 9%, and we saw 4 times 75 basis points rate hike by the US Fed. But all that started to moderate in the second half from July onwards, and then we saw a reversal, meaning FPI started to come back. So while the first half was bad from the viewpoint of FPI flows, but the second half was comparatively better. But overall, if we even look at the entire data, there will be still net outflows.
Net outflows. Okay. And now that India is also, the RBI has started raising rates again, we can expect that to encourage flows to come into India.
Yes. So we need to see what is the quantum of rate hikes by the US and by India, whether interest rate hikes are determined by inflation consideration or also exchange rate consideration, also the stance of monetary policy in the US. So all these conditions will determine the flow of foreign investments. But one thing is for sure that 2023 again is going to be volatile because of what is happening in China. We are seeing the resurgence of cases. We are seeing high energy prices. We are seeing continuation of geopolitical tension. So there would be swings in foreign portfolio investments in the next year as well.
Right. And you had mentioned inflation, and now I know that all of our viewers are very, very concerned about inflation because it's been high and kind of unrelenting for most of the year. Actually, all of the year, even though now it's dipped a little bit below 6%, it's still high.
Yeah.
So now, but do we see a silver lining to this inflation monster that we have?
So 2022 was the year when the RBI missed the inflation target because there were 3 successive quarters of inflation above 6%, and RBI had to write a letter to the ministry explaining the reasons for the failure. But again, since the second half, we are seeing a moderation in inflation, and November saw inflation dipping below the 6% mark. But having said that, what is important is to know that inflation pressures have become much more generalized. It's not just driven by a few items like food and fuel. Now we see that it has spilled over to core inflation. And when it spills over to core inflation, and they're also on all the important items within core inflation, like services, personal care effects, household goods and services, then it is important for the monetary policy to keep a close watch. So it will take some time for the inflation monster to abate, given that there, as we already discussed multiple times, that there has been a transmission of input cost pressures to consumer prices, and till we see that, and now even the goods inflation may be coming down, the services inflation is still higher. Towards that, we know, and even the predictions from the RBI indicate that inflation will be above 5% in the next 6 months.
So, 5% is of course not as bad as higher than 6% inflation, but it's more broad-based, so there are more things that are getting costlier. So that's the kind of give and take that you have with inflation right now. It's something that needs to be looked at. Now, the other main driver of the economy is exports.
Right.
And India has been seeing, not this year. This year we saw exports slow because of the global factors.
Yeah.
But do you now see, are we on a strong footing right now as far as exports go, or are we going to see it slow even further?
It will depend on how the global demand shapes up, because if we again look at the trajectory of exports, 2021 was a very good year for exports. We saw a sustained increase in what we call the non-oil, non-gems and jewelry exports, which is the core exports if we look at. So if we see that 2021 saw a sustained revival after the COVID slump, in 2022 we have seen again a decline, particularly from May onwards, and that if we superpose that with global growth, it's so interesting that our exports follow the trajectory of global growth.
Right.
So if global growth measured by global PMI slows down, exports also slow down. So because our sectors, the sectors that are our key exporters, they are dependent on global demand, be it engineering goods, textile, chemicals. So long as there will be global demand, we should see exports picking up. Now, that depends on how the US economy is faring, what is happening in China, what is happening in other countries. The US, for example, is giving a very mixed signal. We can't say that in the US as of now there is recession.
Okay.
So because their GDP number has been quite robust, their labor market is quite good. So as far as US is concerned, there won't be a sustained slowdown, but we don't know about other countries. So exports is something that needs to be watched out for. And therefore, if exports slow down, the domestic demand needs to be strong enough to sustain a high GDP growth.
And now we have a question from one of our viewers. And he's going to put you on the spot a little bit, because he's asking how many quarters have to pass before our exports may pick up.
So again, it's very hard to give how many quarters, but again, it depends on the global growth trajectory. And it's very important to have a look at some of these international trade reports. There is a report by UNCTAD, United Nations Conference on Trade and Development. They come up with quarterly updates on trade, and they have projected that growth has slowed down for the second half. First half was still okay. Second half of 2022 has slowed down. And they again raise concern, the report raises concerns that 2023 is also going to be a tough year for trade, because global growth will slow down further, because now we will see the land impact of rising interest rates on growth in the coming year. We have seen massive interest rate hikes by the US Fed in 2022. It will start having an impact in 2023. So growth is going to slow down, and if growth goes slow down, there would be impact on demand. So 2023 is going to be a challenging year from the viewpoint of trade.
And now China is another factor. They are opening up all of their COVID restrictions, and cases are rising over there. So we have a question from our viewer, which is that is the rising case count in China going to impact our economy, and so our Q3, Q4 growth, is that going to be impacted? And related to that, the question from me, which is that now that China is opening up, at some point they're going to start exporting again. Is that going to then affect our exports? Because China is an export powerhouse. So will that affect us?
Yeah, so as regards China, we have seen that there has been a resurgence of COVID cases. And according to latest reports, China is going to open up from the 8th of January. And if there is further resurgence of cases, there may be shutdowns or some localized shutdown. So that will have an impact on our manufacturing sector particularly, because we import pharma. Almost 60 to 70% of our raw materials in the pharmaceutical sector is imported from China. Pharmaceuticals, the other items like raw materials for electronics, textile, so they would be impacted beyond a point. So what these industries do have some inventory, but if the resurgence in COVID and the associated lockdowns continue for more than say 2 quarters, then it would start having an impact on India's GDP through manufacturing sector GDP. Currently, as of now, they are well equipped, well stocked, but it needs to be seen how temporary or how permanent the COVID surge is in China, and what is going to be their policy response to the COVID surge.
Right, because on the flip side, if they do open up, then our manufacturers stand to gain, because suddenly you will get a lot of raw materials cheaper.
Yes.
And that will help us.
Yes. So, and on the other side, if they shut down and the oil prices come down, because they are the biggest consumers of oil, so that benefits us. So there are pros and cons of both the strategies, and we need to wait and watch how the trajectory shapes up.
Right. And now coming back to, we talked about how bank credit is growing and how companies are now starting to take more loans. But this is a question from one of our viewers, Anindya Kamal Sen. He says that while India Inc.'s profits are at an all-time high, these profits are not being converted to investments. What is behind this reluctance to invest? And in view of this, what can we do to boost employment, which is another big issue that we need to talk about?
Yeah. So on investment, we briefly touched upon, we talked about that investments depend on having a stable policy environment and a stable macro environment. And currently there are risks to stability flowing from domestic inflation, flowing from global monetary policy tightening, from what China is going to do, the geopolitical conflicts. So that gives a kind of the inhibition to ensure a sustained investment revival. And therefore, coming to what needs to be done for employment, one of the things that needs to be done is to look at the labor-intensive sectors, particularly in the manufacturing sector. Look at the policy problems in the textile sector, because textile sector is one of the major providers of employment. But textile sector has not been doing well recently. So textile sector problems, be it duty inversion or problems with the quality, efficiency, those need to be addressed. Then the PLI scheme, the budget is a time to review the PLI, the production linked incentive scheme, and to see whether they can be given to assigned to some more sectors to promote manufacturing in those areas which are labor intensive. Another strand that can be done or should be done is to look at the Pradhan Mantri Mudra Yojana, which was to provide loans for self-employment, for the loans of rupees 10 lakh for small businesses. So those kind of loans which have been really helpful, and they have not been translated into a very big chunk of non-performing assets. So these also help in addressing the problem of unemployment. And for the rural areas, there is a need to, invest in schemes which promote infrastructure. A lot of these schemes were introduced during COVID times, and such schemes should be encouraged, addressed. construction sector activities, some small budget allocation for such sectors that will generate employment opportunity and promote forward and backward linkages.
Right. But from the regulatory point of view, and this is another viewer who sent in this question, why have the new labor codes not been implemented by the states? Isn't it obvious, he asks, that the growth benefits of these laws would bring political dividends to all concerned? So what is the order?
Yeah. One thing is that the labor is a concurrent subject, and therefore labor codes have been passed by the parliament, but then draft rules have to be notified by all the states.
Right.
Now, what's happening is that some of the states have expressed reservation, especially states like West Bengal. There, the trade unions have expressed reservation on some of the labor codes. So we know that 29 labor laws were subsumed into 4 labor codes.
Yeah.
There's code on wages, there's code on industrial relation, there's code on occupational safety, and so on. So one of these codes provide for allowing employers to fire the laborers.
Yeah.
So trade unions are not in favor of those. They are deemed to be anti-workers. So as a result of elections also coming up, so states are not in favor of going ahead with the labor code. And I think that now the central government is also not pushing the labor codes forward, because states have expressed their reservation that they do not want to, as of now, this is not the opportune time to pursue labor codes because of reservation and opposition by trade unions of some of the states.
Right. And now looking at the government's finances, number one, are we on track to meet the fiscal deficit target that was set for the year? Now, again, a question from one of our viewers is that given that energy prices are still high, does the government have any room to provide any sort of concessions on personal income tax in the budget?
So on the fiscal side, for this year, we are on track because our fiscal deficit target is 6.4% of GDP, and our revenues, especially the direct tax revenues, have been robust. We have surpassed the previous year's revenues by a huge margin, and it is expected that we will surpass the budgetary targets also. Despite increasing the expenditure, we talked about the supplementary demand for grant of 3.26 lakh crore. Despite that, I think we will be on track to achieving the fiscal deficit target of 6.4% of GDP. Going forward, however, as the IMF's report, so IMF comes up with this Article 4 consultation for all countries, and for India, they have proposed that the fiscal consolidation roadmap needs to be much more aggressive. Because the problem with India's fiscal and debt trajectory is that our debt to GDP ratio is quite elevated as compared to our peer economies. We are, though one of the good thing is that it's mostly domestic currency denominated, so it's not foreign currency denominated, but still it is around 84 to 85%. So in order to ensure a meaningful reduction in debt, we need to have the fiscal deficit targets reduced by a big margin each year.
Right.
So that is what is a more ambitious roadmap for fiscal consolidation and a more well communicated, because we have a goalpost of 4.5% of fiscal deficit target by 2025-26. But from 6.4 to 4.5, how we are going to reach that needs to be communicated. So that will give a signal to investors also, whether both domestic investors, foreign investors, credit rating agencies, whether India is more serious about achieving its fiscal consolidation or not. Given in this context about personal income tax reduction, though the government does have a scope for reducing the personal income taxes, but again, it's a tightrope walk between giving the tax concessions, tax up, or achieving fiscal consolidation, given that we know they have recently revised their food subsidy scheme also. They have made the PDS free. So food subsidy bill is going to be 2 trillion for sure in the coming financial year. So depending on how the other expenditure commitments work out, that will determine whether they're going to give this concession on taxation or not.
Right. So it all comes down to whether prices are going to remain elevated, whether the government needs to keep subsidizing the people. That is what will decide whether we get a income tax break. So we got to wait and watch. And now there's one question that we had from our viewers on cryptocurrencies. 2022 has been a year of the crypto prices just crashing. And it's been in the news in a big way. But the government still has not come out with any sort of regulation on it. So what is stopping them and what is their view on it?
They are looking at international experience on cryptocurrency regulation. What is the best framework for regulating cryptocurrencies? How it should be regulated? It's clear that it will not be treated as a currency because it's not a legal tender. That is a rupee, that's the digital rupee, so it won't be legal tender. But whether it will be allowed as an asset or as a commodity, based on that, the entire edifice of regulation needs to be worked out. Whether they're going to give licenses to crypto exchanges, who is going to regulate, SEBI or some other agency, what will be the money laundering regulations governing it? So I think going forward, now that India has assumed the G20 presidency, I think there will be discussion at the G20 level to come up with an optimal framework of cryptocurrency, which will be applicable to all and which will also cover cross-border cryptocurrency flows. So I think we should look forward to 2023 to have at least some guidance on how crypto regulations shape up.
Right. So now in 2022, growth has outstripped our pre-pandemic levels. Inflation has remained high and the outlook is that it will remain high for a while. The banking sector has outperformed. It's done very well. And the good news is that credit is going to companies and to industry, which is a very good sign. But global growth is still a concern. There are major economies in the world that are kind of toying with recessionary risks. China is opening up, but COVID cases are exploding over there. So we don't know how that's going to play out. So again, we don't know how investments in India are going to play out. This is what has happened in 2022. And that's it for us. Have a great 2023 and a very, very happy new year from all of us here at ThePrint to all of you and all of your loved ones. Thank you.